Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
What's up, everybody? Anthony Crudele here, and thank you for tuning in for this episode with Jim Dalton. Futures Radio Show is sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com. Remember, everybody, new shows are posted on Mondays and Thursdays. You can subscribe to the show on iTunes, YouTube, Google Podcasts, Spotify, and Stitcher. If you're enjoying the show, please leave a review on iTunes. This show is also sponsored by Trading Technologies, Footsie Russell, RJO Futures, and Top Step Trader. To learn about some great offers that these sponsors have for our listeners, please visit futuresradioshow.com/sponsors. Now, today I spoke with the author of Markets in Profile and Mind Over Markets, and general partner at Jim Dalton Trading, Jim Dalton. Jim is one of our top requested guests, so it was great to have him back on the show. And we kicked off today's show by Jim explaining how he uses Market Profile and how he believes that by using Market Profile, it gives him an edge in his trading. He explains how he prepares, anticipates, and executes his trades. A year ago, Jim had a health scare. So he shares with us what happened to him and how he's doing. Because Jim is turning 80 this year, I asked him, what has he done over the course of his career to stay in such good mental and physical shape? Last but not least, I went to Twitter just before this interview aired with Jim and got some fantastic questions from you, the traders. So we did a rapid fire segment with those questions. So without further ado, let me take you right to the interview with Jim. Market Profile continues to grow with day traders. Why do you think it's so popular with traders?
Unfortunately, people put labels on things. If they had a deeper understanding that Market Profile is not, it's simply a tool that allows you to organize the market's continuous two-way auction process. For example, I am not a profile trader. I'm a discretionary trader, but I use the Market Profile to organize the market's data. If you have organized data in front of you, I think it gives you an edge. This is what scientists have done for years when they use distribution curves. For a distribution curve, you need a constant, and constant in the profile is time, a variable, which is price. You compare a variable to a constant, you get a distribution curve, and a distribution curve is nothing but organization of data. And once that data is organized, it's easier to tease important information from it.
Okay, you say you're not a profile trader. So are you using market or volume profile for what I would consider confirmation?
No, simply as an organizing tool. And let me go back to the idea. I do not use volume profiles.
Okay.
That becomes an issue constantly. I think people like volume profiles because it's easier. You get one exact number. The problem with it, the three components that make up a profile are time, price, and volume. Time is the most important aspect of any investment. Something that's not accepted over time is rejected. And when you use a volume profile, you've taken away the element of time. So I only use the traditional profile that uses TPOs as the point of control, or the widest line reading from left to right, closest to the center of the range.
Okay, well, let's talk about your overall trading process. And we'll begin with your preparation. Take us through what you're doing each morning to prepare for the day before you begin trading.
Well, it's not in the morning. The first thing I do to prepare for the trading day is at the close of the previous day. As a short-term and mostly day trader, as you end a particular day, your focus is usually very narrow, very tightly narrowed. And as you know from trading for many years, markets get a tone for a particular day. Once that day is over, the tone may be gone. It's easy, for example, on Friday, the market was breaking hard on the close. And if you were just focused on what price was doing right then, very short term, you get very negative. So the first thing I do, the minute the market closes, I go to the bar charts and I go to the monthly bar. So I go from the shortest time frame as I close the day immediately to the longest time frame, which I use as the longest, the monthly bar. I then go from the monthly to the weekly to the daily and then back to the profiles as I prepare for the following session. For example, last Friday, the market was not complete. For example, the all-time high existed in the overnight market. If you observe markets over a long period of time, you will know that it's unusual for an overnight or electronic high to last for very long. That's just simply one data point. The next data point, last Friday's high was not complete. In other words, there was no excess or single prints at the top of the profile. Additionally, when I look at it, volume was below average. So even though you had price selling off quite sharply and selling off near the close, when you go back and look at the charts, you say, wait a minute, the trend is up. And the trend is the most important thing I think that you're going to deal with in the market. So I put my mind back and I said, okay, the trend remains higher. Then I work backwards. And when I get back to the profile, then I start thinking about preparation for individual trades. And that then becomes a question of looking at data points. So one data point would have been the all-time high being made in the overnight market. So that's a data point that says the odds are we could go higher. The second data point was that no excess or completion to Friday's high. That suggested we could go higher. And the third major data point was volume was below average as the market broke on Friday. So I put a tweet out this weekend and I said, all I saw was liquidation on Friday. So as part of my preparation, I'm saying all I saw was liquidation on Friday. I didn't see a more potent combination of liquidation and new money selling. If I'd have seen, higher volume, better tops, I may say, wait a minute, maybe we have change going on. So when I put out a post this weekend, I said, I don't see any indication of any significant change having taken place in the market. And of course, I don't know, I'm not looking at the market right now, but we've been, inside Friday's range. Then when it gets to the morning, which is, when just before the market opens, I look and I see what has happened in overnight activity. Overnight activity we measure from the close of the previous session. So all of the trade overnight was higher. I think for 7 or 8 days in a row, there has been a counter auction or a correction relative to overnight inventory. So overnight inventory gets too long, a counter auction would be some selling to bring that inventory back into balance. And of course, we got some liquidation this morning that brings that inventory back into balance before the market moves higher. So I'm prepared with that. Next, I say, where are we going to open? And I look and I say, we're going to open today someplace in about the center of Friday's range. When I see an opening in the center of Friday's range, say the odds are that there's no significant change today. More than likely, we're going to see a rotational market, some rotation up, some rotation down, bringing the market into short-term balance. And that's consistent with on January 14th, Tuesday, January 14th, tomorrow, we start to see the earnings season get underway with, people like JP Morgan, Citibank, Goldman Sachs, et cetera. So, the markets taking a little breather, and let's see what tomorrow brings, because that could usher in change or increased volatility.
Okay, just a couple of things I want to clarify. First is you only trade the E-Mini S&P, or at least that's your primary market, correct?
That's my primary market because most of my time now is spent on education, and it's the best and most efficient market in order to conduct education.
And going through your preparation, you wait for the close of the day, and then just talk to us about how you are, your process for this. I mean, I understand that you said you're looking at monthly, weekly, daily, and then you're going to market profile. Are you then writing notes down? Are you marking things on your charts? Are you writing notes so the next morning you wake up, you have this stuff in front of you to then get ready to anticipate for the day?
Yes. The contrast, a lot of people think they're doing their preparation by marking important points or references on their charts and graphs. I think that is insufficient. What I like to do is when I do my research, I like to bring it down to paragraph form. And the reason I like to bring it to paragraph form is one of the most important things we deal with in trading is synthesis. And it's too many people trade off of, single references, and it's really much more complicated than that. But the synthesis allows me to bring all the pieces together. For example, when I write up for Friday and I get prepared for Monday, it's okay. Part of the biggest picture is that all trends remain higher. There was no indication of any serious selling, and the market appears to be overextended, in my opinion, but no indication that there's been completion to the current upside auction. So then the synthesis comes out that I don't anticipate any major change taking place on the start of the following week. But I think putting it in paragraph form is far more important than fooling yourself by just marking down references. It used to be when I ran a trading desk, I ran an institutional trading desk. And when I knew a trader was in trouble or with a position, or at least I thought they were in trouble, I would bring them into my office. I'd put a legal pad in front of them. I'd say, write down your thoughts on the trade. And they said, oh, I understand the trade. I said, no, write it down. And what I found, if you can't write down in a paragraph synthesis of what you're really looking at, your clarity on the market isn't anything or even close to the level that you think it is. You start to write it down and you stumble, you better stop and take a second look. So I think it's important to put it in paragraph form, which is my way of making sure that I've addressed synthesis.
I love that you talked about writing things down. I'm writing things down actually as you're speaking today. And from Linda Raschke to many other traders that I've had on the show, there's just something about, I think, writing something down that our brain works differently. I think that there's a connection there. And that's why I really asked you about how that process works, because if you're marking something on your charts or if you're writing down just some notes, how that carries into the next day. Now, take us into that next day now. You prepared. You started at the close of the market. You come in. Bell rings. What are you doing anticipating a trade? What are you looking at on your charts, and then eventually get to the point to where you say, this is it, I'm getting in here?
The first thing I'm looking for in the morning is the potential for change. And the more potential for change, the bigger the opportunities will probably be presented in the market on that day. For example, as I said this morning on Monday the 13th of January, the market was opening within about the center of the previous day's range. That indicates to me that major change is on the lower odds end. Had we gapped higher or lower, and I only measure gaps from the high or low of the previous session. I do not measure gaps from the settle. A gap to me would have to be above or below the previous day. If I open above or below the previous day, I am probably looking at the potential for either major change or a failure to follow through on that change. So for example, if the market opened higher, gapped higher, now I'm talking about opening higher, I'm talking about opening above the previous day's high. The odds are that that market is either going to make a substantial move to the upside, or the market's going to fail to carry forward to the upside. If it fails to carry forward to the upside, then the odds increase that we re-enter the previous day's range. If we re-enter the previous day's range, then the destination trade becomes, at least the potential, not the actual, but the potential becomes the opposite extreme of that day. So I'm always looking change. The biggest opportunities come when there is change in the market. And I'm always wanting to know, am I looking for small trades or am I looking for larger trades? Today, I'm looking for smaller trades. Now, we talk about, the execution side. On Friday, there was a late price spike to the downside. I have what I call the spike guidelines. When a market moves down late in the day, either spikes higher or lower, a lot of times there's not enough time left in the trading session to know if that price spike was accepted or rejected. So the spike guidelines, which I put out in a post on the Twitter this weekend, said the spike guidelines. If you open and remain above the top of the spike, that's the most positive moment for Monday. If you remain below that spike, that's very negative. Within the spike shows you're getting some acceptance of that spike down. Well, now talk about the execution. This morning, as I already said, I had an opinion that there was probably no major change setting up because of the data points that I talked about earlier. If you look, and you'll see that the morning's low was a single tick into the spike. So that gave me an entry level right there, right at the top of that spike. That spike becomes support. If it opened below the spike, the top of the spike is resistance. If it opens above the spike, the bottom of that spike is support. And the market went a single tick below support, and that was an entry level for a trade. It gives you, you've got a place to enter. It gives you an indication of where you would want to put your stop. You don't want to get accepted back down within that spike. Now, what people misinterpret a lot is they constantly come at me about, well, exactly where do you get in and where do you get out? Today happened to give an exact level. Many times there is no exact level. It's just that the odds are building up, that this market is having trouble on the downside. For example, volume is drying up. We're not getting, good enthusiasm. And at that point in time, I don't know the exact level. It's an odds place, and I will enter the trade. And then the most important thing, I think, for traders is learning how to monitor for continuation. Too many times, traders focus on where do I get in, where do I get out, where what is far more important is knowing how to monitor for continuation. For example, when I buy this morning, I want the market to remain above the top of that spike. Secondly, I want the market to get back to Friday's point of control. Then my next objective will be, can the market get above the overnight high, followed then by Friday's high? So I'll have these guidelines along the line, or guideposts along the line saying, okay, if I'm going to get upside continuation, what do I need to see? And if it can't do that, then you say, okay, the odds are against continuation. I need to exit that trade, whether it is at a profit or a loss. Learning how to monitor for continuation will allow you to do far more trades and not spend so much time agonizing over exactly where do I get in and exactly where do I get out. Now, it's a little more nebulous. It takes more experience in order to gain that type of experience. But that's really what experience is about.
Hey everybody, a quick pause here to talk about Footsie Russell. They are a leading global provider of benchmarks, analytics, and data solutions. The Russell 2000 Index is a key benchmark for small cap U.S. stocks. Be sure to check out the E-Mini Russell 2000 Index Futures contract, symbol RTY. For more information on Footsie Russell and their products, please visit footsierussell.com. I want to talk a little bit about position sizing. I always talk about on this show and on social media, I know when I want to be big, small, or not at all. Are you all into your positions? Are you scaling in? Are you scaling out? Talk to us about how that works.
Well, you've hit me on one of the areas that I'm very embarrassed about. I don't like scaling in. I tend to be more black and white. I'm either going to be in the trade or out of the trade. And I mean, it's nothing's 100%. As I've said, I've never had a rule that I haven't broken. But one of the things that I am probably the worst at is adding to existing positions. And that's probably cost me over the years, but it's just psychologically, if I have a position that starts to work for me, I have far more of a tendency to cut that position back. I will scale out of a position. I rarely add to positions. And I think that's a weakness in my trading, in my approach. But I think I just have too many scars from becoming too greedy over the years. And I've heard some disasters from the other night when the market broke down, when we had the war footing with Iran, and the market broke so hard. I mean, there were some traders that I've talked to have some really serious losses. They got caught up in some of these trade rooms, and they just kept adding to the positions on the downside. And of course, it was just a huge trap. And I guess that's happened to me too many times. So I tend not to be a good add-on trader. And I think that's probably my biggest weakness.
Yeah, and actually for me, my greatest strength is actually, when it comes to execution, is that I could be really aggressive when I see what I want to see. But it's also my greatest weakness because I'll overtrade because I always think I'm seeing edges, Jim. I want to go back to the beginning of the interview today and talk about how market profile gives you an edge. I know you touched base on it a little bit, but can you explain a little bit more on how market profile gives you an edge in your trading?
It just gives me an edge because it allows me to organize the data. And if I can, it's what scientists have done for years. They organize data in order to tease information from it. Too many times traders get too emotional on the market. And if you think, and I've talked about this extensively, so many times traders like to think they've got great instincts. I've always said I can make somebody smile if I walk up and say, you should be a trader. You've got great instincts. And they'll smile and they're just so proud of that. And if we find out our instincts aren't anything like we think they should be, the simple example I use is, you're riding a motorcycle and you're going to give somebody a ride on the back. You're leaning into the curve and they're trying to sit straight up. Or another example, the first time I ever went off a ski jump as a kid, water skiing. They tell me that you go up the ramp, water and, wood has less friction than straight water. Yes, I heard them, but I certainly intuitively didn't believe them. And of course, as I go off that first jump, my feet and my arms are straight in the air. And when I land, it's straight on my back. All of a sudden, I learned that my intuition was wrong. And I think that organizing data just helps me keep a better perspective and control over what is actually going on in the marketplace. And that's all it is. The profile doesn't tell me to buy. It doesn't tell me to sell. It just simply allows me to organize the data and observe that organized data more objectively.
Hey, everybody, I want to take a quick pause and talk about RJO Futures. They are a long-standing brokerage firm with personal broker relationships to learn, discuss, and trade the futures markets. To learn more about RJO Futures, please visit rjofutures.com. So, Jim, you're going to be 80 years old soon. A year ago this week,
I hope.
actually. You will. A year ago this week, you had a scare. Talk to us about that.
I had surgery for what's called trigeminal neuralgia on the 7th of January. Evidently, a piece of plaque got knocked loose. So when I woke up on the morning of the 8th, I could not move any fingers or toes on the right side of my body. And the first crazy thing that came to my mind was that there was nothing wrong with me mentally. And I thought, I can still trade. And immediately I thought about Stephen Hawking, with all the problems he had, he could still communicate. And I was crazy. I mean, that's, I couldn't tell my best friend, my partner, I couldn't tell her that was the first thing that went through my mind. I probably would have had a second stroke when she got done with me. But then on the third night, I woke up and my arm was straight out to the right and the fingers fully separated, which I hadn't been able to do. What that told me was that mentally, it was a question of rewiring the brain. And from that point on, I just started working a little bit at a time. Took me about a week before I could make a partial fist. And now it's a little over a year later. I can walk about a mile and a quarter at a time. I'm back to the Y, lifting weights. And it's a lot of it has to do with reprogramming the brain, which I think is very closely related to trading. So many times, I don't know what the actual numbers are. We see constant anecdotal evidence that, 95% or better of traders, short-term traders, don't make money. And I think an awful lot of that is, that someplace start over and kind of rewire the brain as to what trading is about. But I think it's doable, just as I think it's, in my case, I was very fortunate. It wasn't a total stroke, but I do think we have a lot more potential to rewire ourselves than we realize.
And thank you so much for sharing that story with us, Jim. Everyone knows that I've shared my story about me having a heart attack. It's been almost 6 years, actually coming up next month. And you and I have talked about that as well. And one thing that you and I both agree on is staying in shape. Longevity in this business goes beyond just being good while you're at your screens. It's doing things when you are away from your screens. Talk to the traders out there and just give us an idea of what you've done throughout your career away from the screens to stay in physical shape that you believe have helped you with your mental and trading game.
Well, I like you say, I think I played racquetball, I played tennis, I hike, I travel, and I do a tremendous amount of reading. I enjoy reading, and I do some writing in there. And it's amazing. What always amazes me is, in one aspect, you think you've totally separated yourself from trading. And I'm always amazed at how many things you find out in the other world that are really relevant to trading. You didn't set out to think about that at all, but you say, wait a minute, that is relevant. One of the examples, and I've been talking about this quite heavily for the past couple of years, is this idea of chunking. And chunking, it's a scary term. It's just a psychological term that, how we chunk information. The example I've been using, when you back your car out of the garage, it's amazing we can do it. You put the key in the car, you open the door, you adjust the mirrors, you back a few feet. Before long, you do that as kind of one fluid motion. It is very difficult to read a book on performance that doesn't have a serious section on chunking. So I was reading Josh Watson's book, The Art of Learning, and there's a huge section in there on chunking, and you start to think, wait a minute, when you do he was a master in chess and also in martial arts, and you start thinking about a martial arts move, it's not one move. It's a series of moves. They may look fluid and it may look like a single move, but it's not. And I think that's relevant to trading. I recently read a book. I think the name of it is Range. I think if I remember right, the author is Epstein. And in that book, he's addressing, maybe it's not so important to have your kids, go on their head for their first career right out of college. Maybe they're better off to be late bloomer, so to speak. And all of a sudden, here he's talking in the middle of this book, he's talking again about chunking. How you gather information, how you become a professional, how you become proficient in anything. So again, my time is spent deliberately away from trading, but I'm always amazed that you run across things that are relevant. It's no different, when you're behind when you're playing somebody in sports or some kind of activity like that, and you either see them come back or you come back, and you say, wait a minute, we have a tremendous ability in us to overcome obstacles if we can keep a clear focus. So I set out to do things totally unrelated to trading, but somehow they seem to always work their way back.
They really do, don't they? My wife is like, you compare everything to trading, and something that I picked up over about 6 years ago was this game called golf. And I started playing golf and figured, you know what, this is going to be a great escape from trading. Go out there, hit the ball. I got addicted to the game. And I am amazed at how many things on the golf course compared to what I do in trading. And really how by playing golf has taught me a lot about myself, and I believe has helped me become a better trader. And Jim, I actually did a tweet the other day for announcing to everybody that you were going to be on the show this week. And we've had such a strong response from people wanting you to come back on the show. And so I wanted to give Twitter an opportunity to ask you some questions. So I'm not going to be able to ask all of them, but I have a handful of them. So maybe we'll do a little rapid fire segment if that's okay with you.
Sure.
All right, everybody. Our rapid fire segment is sponsored by Trading Technologies. Trade the global markets with TT. They are the world's fastest commercially available futures trading platform. Now with integrated tools for advanced options trading, cryptocurrencies, and trade surveillance, you could try it now for free at tryttnow.com. Jim, first question we got from Twitter is from Like Water Trader. And they ask, I'd like to know what Mr. Dalton thinks of subconscious mind's role in day trading. And how to avoid or prevent as much as possible attentional blindness.
Preparation. The preparation doesn't, my preparation, we addressed this question early, and I said it really starts as the market closes. That's not quite true. I am making notes throughout the day, things that are relevant. So it's ongoing preparation.
All right, we have my friend Josh, Trade with Profile. He asks, as you look back at the decades with Profile, what has remained constantly effective and what has proven to have less efficacy?
I don't think there's been any real changes. The three components are time, price, and volume that comprise the profile. And those are components that are applicable to any market that is financial in nature. Yes, there's some things that were talked about early on, 80% rule. If you re-entered the value area, 80% chance you'd go to the other end. That was something that, I was told by the Peter Stottlemyre. And as I did my own research, I found that really wasn't applicable. So I think the basic principles have remained the same. And I think that's the beauty of the profile, that it's just a tool to organize data.
All right, next up we have a question from Daniel Greenemeyer. With so many VPOCs and gaps below on ES from October low, do you still believe in the probability they will get retested? Has your theory changed or evolved?
One of the most important things and it is The theory I talk about is being able to compartmentalize things. What destroys us so often as traders, particularly short-term traders, is we have these biases that we carry forward. One of the things I've talked about is, the markets seldom hold more than 3 gaps. And remember, I only measure a gap from the previous day's high or low. If, in fact, the market, as in the current market does, we have more than that number of gaps, what you need to do is compartmentalize those areas where the market could be weak later on. Put them aside in a separate compartment. Don't pull them back out until the market gets back down to towards that level. My suggestion to short-term traders is get in front of the mirror every morning and say, I am a short-term trader. My longer-term biases have no relevance to what I do as a short-term trader.
Next question is from Hitesh. What does he give more credence, trend or value?
Oh, trend. I mean, they're really, it's not one or the other in there, but I always start with trend. Is the market trending? And then, of course, trending becomes a terribly difficult definition because everybody has their own definition of trend. My trend, I use the monthly to really get a better idea of trend. But within trend, then value throughout the day, as you know, value represents about 1 standard deviation or just slightly less than 70%. It's just a way to filter out the noise throughout the particular trading session.
Next up is from Calgary, Chad. Has Jim ever seen the structure we have below us currently in the past? He has many years' experience. Curious if he has ever seen this before.
You're never going to see the exact same structure. Markets are just too dynamic for that. But similarities, absolutely. And I've traded beans, I've traded gold, I've traded almost anything that moves out there. And people think we have more volatility today than we used to have. Some of the markets in the past had huge volatility. So yes, I've seen similar structure. And normally what happens when your question, I'm assuming your question has a bias to it, that the underlying structure is not very strong. And that usually happens when momentum trading is at its peak. And I'm guessing that that's what we're seeing right now. We're seeing momentum trading that really started very heavily in December. And momentum trading, I don't think we've had 2 back-to-back down days in a long time. And the markets go until they're over. And so far, we have no indication that this market is over. But yes, I have seen similar structures.
Last question. A lot of people were asking about this. Are you going to write any books on order flow?
No, I won't write any books on order flow, but I will suggest there's a great book out, and at least I think it's a great book. And the name of the book is The Man That Solved the Market. It's by Jim Simons, who was, the founder of Renaissance Technology. When he cashed out of Renaissance, if I remember right, he took out about 23 billion. I mean, Renaissance did a lot of work with, trying to approach the market with algorithms, mathematically, etc. Not only is the book fun from understanding the market, it's also fun that, here was one group of his partners funded Trump. The other group funded the Democrats when they took back the House. So there's an awful lot of other things going on in the book. But one of the takeaways that I found, and something that I believe for a long period of time, is computers are really good at taking pennies out of the market. And I think they've replaced scalping. They're much faster. As you may remember, one group spent $1 billion to build a telephone line from Chicago to the clearing centers for the NYSE in New York, just to get that, tiny fraction of a second to go after, get an advantage on order flow. So I think that I think that the market really on order flow I don't think as individuals that is going to help us anymore. I think it's the world of the computers, and I think we should spend our time more on understanding the importance of synthesis, and I don't think that computers are good at that yet.
Jim, where could people find you on Twitter, and give us a website to check out?
On Twitter, you can find us at Dalton Trading. Our website is Jim Dalton Trading. And then on Twitter, what I usually do, one post on Sunday. And that post on Sunday is usually just to keep our name in front of people. So when we have intensives or other products that we're selling, that you at least know about us and where to go and take a look at what we're offering. This weekend I did 3 posts. One post talked about an article, an in-depth article that we did on what is trading really about. Another talked about order flow, and a third was titled The Week Ahead, which covered what I talked about earlier, that the fact that the data points didn't point to any significant downward pressure on the market coming up this week, or not this week, but to start the week. I think the earnings come out tomorrow, and that can change everything.
Jim, what can I say? It's an honor every time we speak, my friend. I can't thank you enough for taking the time, come on the show, speak with me, answer all these questions from Twitter. You're just awesome, my friend. I like I said, I can't thank you enough for coming on Futures Radio again.
Well, thank you for the opportunity.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a review on iTunes. You can listen to all of our episodes on futuresradioshow.com, iTunes, YouTube, Google Podcasts, Spotify, and Stitcher.